Hi everyone, this is Pete here. So last week we had the FOMC meeting and the Federal Reserve raised rate as expected, but the market reacted very violently. So today we're going to talk about, is the Fed really trying to crash the market on purpose? First, let's take a look at the market charts right now. As you can see over here, right, the market had a very nice uptrend, but right now it is being broken and we had a really like a waterfall kind of cascade of prices coming down, selling back to the June low, right? So right now, everybody is looking at whether will the market hold this level and continue to head upwards from here. That will be good news for many investors, or will it continue to crash downwards, right? Resuming the overall downward trend. But firstly, to understand why the market crashed so violently is to ask ourselves what happened at the FOMC meeting. So during the meeting, initially, there was a very good response because the Federal Reserve only raised the rate by 75 basis points, which is what was largely expected. However, you can see from here, after the announcement, when he go into his speech, that's where things just fall apart, right? The market just reacted very badly, crashing over 100 points, right, in a matter of hours. Now, what did he say that spooked everyone, right? That changed the initial uptrend to the subsequent drop in price. And basically, he summed it up in a very simple way is that he said that the future rates are going to be much higher. Now, this is not something that we did not expect it to happen, right? It is not a matter of like, we say that there's not going to be no more inflation and you know, he's just playing with us and saying, no, there are more inflation. We knew that inflations are coming. We knew that interest rates are going to go up, but it is the expectation that changed. So once again, guys, remember one thing about the market is that it's not just a market of valuation. It is also a market of expectations. How do the people see that the Federal Reserve will do in a few years' time, right? So previously, they expected that the Federal Reserve will only raise the rate, right, to about maybe 4% at the end of 2023. But now they are saying, based on the dot plot, right? This thing is called the dot plot. That if you look at it, every dot represents a single representative in the meeting saying what they think the future rates will be. And you can see that by 2022, they are expecting to reach about 4.25% over here, right? You can see majority are here. And the majority went even higher into 2023, raising it to 4.75%. Only dropping it down when we come into 2024 and then 2025. Right? So this was not what was expected. So everyone expected the Federal Reserve to raise rate less than 4% and then pause there. But instead, they raised a lot higher. Now, to understand what the Federal Reserve is doing to control inflation, I'll just use the analogy of cooking an egg, right? How do you cook an egg? Is that you heat up the pan and then you anticipate how cooked the egg will be, right? Because if you just look at this egg over here and you think that, it still looks pretty raw, isn't it? And you decided to leave it up there for a few more moments, but by the time you turn off the fire and take the egg out of the steaming hot pan, guess what? It will be fully cooked. So this is the same as the economy, right? All the reports out there that talks about inflation, talks about jobs are actually lagging indicators. They are telling you what has taken place in a few months ago, right? So if the Federal Reserve keep raising rates until they see the inflation coming down, but it has already taken place earlier on, right? So it will be too late. So they will have likely kept the interest rate high for way too long and the economy will be overcooked. The best way to cook an egg is like Gordon Ramsay.
But the secret behind the scrambled egg is to start it on a nice sort of generous heat, take it off the heat, go back to the heat, take it off the heat.
Right? You heat it up a bit, take it away from the fire, and then observe. If it's not done yet, guess what? Put on the fire back. So once again, guys, remember this. Another point is that whenever we look at economy, recession, remember the stock market, it front runs the economy because all the investors are asking ourselves, going forward, 6 months, 9 months down the road, what is it going to be? How the economy is going to be? So if you feel that right now is at the bottom of the economic recession, like for example here, guess what? The market bottom will have already taken place months before, right? So the truth is, are we in a full-on recession already? I don't think so. I believe we are somewhere in the early part of the recession. Therefore, we are entering to a late bear market stage. But of course, nothing is certain, right? This is just a form of a probability, right? I believe there's a high chance that we are in this area. And this should help you to decide what you want to do with your portfolio. And to me is this, right now there are many companies out there that are selling at a fantastic price. And I'm just looking at, which are the companies that I can put onto my portfolio, be it if I'm using stocks or if I'm using options. Now next, let's look at some of the other indicators to see if we are already in a recession, as I just mentioned earlier on. So if you look at one of the most common one, which is the 10-year to the 2-year spread, you can see that we are already in the recession, right? Whenever it goes deep, right, it will be a sign where the recession is going to come really, really soon. Okay? Now there's another spread that you can look at, which is the 10-year to 3-month spread. Okay? Now the 10-year to 3-month spread is a bit more sensitive. It is harder to come by, right? So the last time we saw the 10-year to 3-month spread took place here, right? We had about 4 months, right, where we see the full-on recession. And right now we are teetering, right? We are kind of like coming very, very close, but not going over it yet. So this could be saying that, hey, maybe in terms of where we are in the market right now, it is true that the market is already, the economy is already in the early recession stage, right? When we go on to a full recession, actually you will expect the market to slowly recover. Another thing that you want to take note of is the high yield market. Now, this is not something that everyone looks at, but as a day-to-day, I look at this because I want to know what are the bond traders thinking, right? And you can see that the high yield spread market in the US is not really that bad right now, okay? So historically, what we see is that whenever there's a recession period, over here in pink, right, the high yield spreads tends to be very, very high, right? It tends to at a very high level when it gets started. Whereas right now we are actually, kind of at a historical average. So this is one way to judge whether, do you think, right, that we're going to go into a full-on recession. So which is why it aligns with my thinking that I think we are at a stage where it's more like this, right? It is an early recession, maybe give it a few more months, right? We can transit from an early recession all the way down to a full recession over here. Now next, one more thing is that you can see US Treasury has been dropping and dropping, right? This is where it's very interesting. A lot of people like the 60-40 portfolio, right? And this is the year where the 60-40 did not protect you. Why? Because we are having an economic slowdown. At the same time, the Federal Reserve is increasing the interest rate, right? When the interest rate goes up, the Treasury yield goes up. Now, when the Treasury yield goes up, the price goes down. So one thing is that right now, even when the yields are coming up, right, with the prices of Treasury going down, there seems to be no flight to safety from the institution. That means that the institutions are not clobbering to buy Treasuries right now, like what we saw in 2020 during COVID. So to me is that it doesn't seem that the market feels a lot of fear at this moment. So which is why, once again, I think we are in the early part of a recession. Another good news that perhaps will give some investors some confidence is that right now it seems that the inflation numbers is peaking. Okay, so this is copper, and copper in the investing world, we always call it Dr. Copper because it's one of the most commonly used metal. And you can see that the copper demand has kind of revert to the mean, right? The mean here being the 200 moving average. So this is a good sign. If this can continue, likelihood we have seen the peak of the inflation. Another indicator that we looked at over here is the volatility. Now you can see that this is the volatility chart. During the last few recessions, the volatility was super high in 08-09 and also during the 2020. Whereas right now, where is the volatility? The VIX is only at about 27, right? Historically, it's about 20. The low end is about 10. So yes, we are slightly above the historical average, but it's nothing alarming as of yet. Alright, so Pete, you're talking about all the bad news. Is there any good news that we can expect? So one thing is that the Federal Reserve, during their meeting, if you look at the transcript and the data they send out, they say that they do expect the GDP to improve, right, going forward. So you can see that the real change in GDP, they expect next year to be 0.2% and then later on going to 1.2 and then 1.7 and then going to long term of 1.8. So they do expect GDP to continue to improve over here. And they also expect inflation. So over here, we are looking at core PCE. Now, this is another form of inflation that is different from the last round of inflation that we saw. This is where they took away energy and they took away food because these are very highly variable. So this core inflation PCE should be relatively stable, and they do expect it to continue to trend downwards from 4.5% all the way down to 2.1% going into 2025, right? So these are the good news. And the good news is that really out there, I see a lot of good companies are getting cheaper and cheaper and cheaper and cheaper, right? So yes, of course, with a very high interest rate, people will say, hey Pete, you need to revalue your company. Maybe they're no longer cheap in that sense in the current environment. But one thing I want you to judge for yourself is ask the question, will the high interest rate environment last for a long time? When I say a long time, I mean like 5 to 10 years, because that's what you need to use when you're valuing company. And in my view, I do not think that interest rate can stay high for so long, because historically it has not, okay? Even during the 1970s, where Paul Volcker came in and raised the rate all the way up, I think to like 12-15%, it only lasted for a year or two, okay? Now, another thing you want to look at is the put-call ratios over here. And you can see from this chart right now, the put-call ratio is at all-time high. That means the market is paying a huge premium to buy protection on their portfolio. So for those of you, I know many of you out there are thinking, hey, you know, the market is dropping, let me just buy some puts, buy some speculative position over there. Be very careful if you're trying to short the market, because right now, if you're buying a put option, you're paying a huge premium. And for those of you who are shorting the market, just take note. These are the moments where you can really get your face ripped off, right? When the market has already fallen so much, and when it bounces up, it could have a very violent reaction. So can we still avoid a recession? So Pete, you say that we are into an early recession, maybe going into a late stage recession later on. Can we avoid it? Now, I think there are two things that can potentially help us. The first one, like I mentioned, is the PCE, Personal Consumption Expenditure Index over here. So you can see that PCE has been hovering around 6.3 to 6.8%, right? The September PCE is going to come out really soon. So we want to see that the PCE number goes down. So everybody out there, please spend less, right? Show the Federal Reserve that we are serious about bringing the inflation down. Now, the second thing I think that may bring some short-term relief is the US midterm election that is coming up. Okay, so traditionally the market has rallied into election years. Okay, the later part of the election year. So we hope that this will be the case as well. And for those of you who are not aware, the US midterm election is going to come on the 8th of November this year. Right? Now, talking about PCE, why is it so important? Because if you look at this chart over here by Deutsche Bank, right, historically, the Fed funds rate, which is the dark blue color over here, okay, has spent most of its time above the core PCE, right, is to curb the overall inflation. Only in the last, I would say, 12 years where we saw that core PCE is actually higher than inflation, where the Federal Reserve artificially lowered the Fed funds rate. So right now, core PCE is still higher, and while Fed funds rate is slightly coming up. So the best thing we want to see is for the PCE to come down so that the Federal Reserve will not have to raise the rate a lot higher than it should. And the other good news that I think everyone should still bear in mind is that half of the inflation rate right now that we are seeing, all right, based on the US Bureau of Labor Statistics that show us in August, is actually supply driven. That means the lack of supply. So hopefully when China slowly opens up and the world just goes back to its production stage, inflation pressure should ease considerably going forward. But before I end, I want to share with you one other question, right? Is that, but what if we are already in a recession? Now, why do I say that? Is because while GDP is continuing to grow, but it has slowed down in terms of its growth. We already have the 2 quarters of GDP growth slowing down. So that technically already shows that we are in a recession. And historically, if you look at the chart over here, you can see that based on past history, an average recession lasts about 9 months. And, you know, we are already into this down market, this high inflation environment for, I think, more than 9 months actually. So could we already be an inflation recession? If that's the case, then it's great. That means we could be coming out of a recession really soon. Now, another thing I want all of you to take note of is the 10-year Treasury yield. Now, the 10-year Treasury yield is not determined by the Federal Reserve. When they raise rate, 10-year Treasury yield may not react immediately, right? Now, who determines the 10-year Treasury yield is actually the market. So right now, the market is thinking that inflation is likely to persist and the Federal Reserve will continue to raise rates. So therefore, the 10-year yield is going in front of the curve, rising to a 3.87% high, right? This is bringing it even higher than the last high we had in 2018. Now, why is bond yield going up important to know for investors in the market? Because when there's an increase in bond yield, what we see is that there's a compression in market multiples. So if you look at this picture over here, the light blue line is actually the 10-year Treasury yield that is actually inverted, right? So basically, the lower it goes, the higher the 10-year Treasury yield. Whereas the dark blue color over here is the S&P 500 price to earnings multiple. And you can see that traditionally it has really been following each other very closely. So in order for the market to recover, not just that the earnings has to improve, but also the multiple needs to improve, right? So right now you can see the 10-year treasury yield is coming to this point where it's really, really high. The market is likely in the short term going to continue. So we want to make sure that we monitor the 10-year treasury yield to understand where the market will be going. Now, in terms of multiple, where is the market right now? Looking at the market valuation, you can see that right now we are at about 18.66 times price to earnings. Now, this is actually quite an acceptable number. It is historically not super high. Why? Because the average is about 16. And therefore, the market correction right now, to me, is a very healthy response, right? Bringing the valuation back to its average. So if we take 16 as the average mark that the price can pull back from the current level of 18 times, that also means if we take the earnings of 203, which is reported by the market right now, we are expecting the market to pull back all the way to 3,248 points, right? So this is the blue line over here that I've drawn. That means the market potentially can have a bit more leeway to go. So I hope that this one doesn't just give you guys fear, but also give you guys the opportunity, right? Optimism that, hey, the market is going to be even cheaper for you to buy into good companies. So what should you expect going forward? So I always want to refer back to people that I can rely on to understand the market. And of course, once again, is reading the words of Warren Buffett, right? So I would say, in short, you must expect more volatility in the market. And I think in general, this will be good for option sellers. Now, for those of you who have attended my program, you will know what we do as option selling. Now, for those of you who are not into option selling, please make sure you know what you're doing before you try any of this, okay? Now, second thing is this, right? I also believe in slowly buying into the stocks of a good company, right? Investing is not just about, oh, I'm going to have all my portfolio in options. I also want to have long-term holding position, right, of stocks of the great companies out there. And last but not least, I want to share is that I also will not trade the Fed news out there. A lot of people say, hey, you know, P, if I expect the Federal Reserve to raise the rates, then maybe I should short the market. If I expect the Federal Reserve to drop the rates, then maybe I should long the market. Now, to give you a perspective why you shouldn't do that, just remember, about a year ago, right, in 2021, the Federal Reserve and Jerome Powell in specifics said that they will not raise rates on inflation fears alone, right? So he said that he's not expecting to raise rate, and so much have changed. Now he's talking about raising it beyond 4% and much higher is needed. So if you're just trading on the market news, you can be very badly misled. And last thing is to look at the long-term return of the S&P 500. If you zoom out, of course, this is a very long-term chart over 150 years. But one thing you can be certain is that if you pull out your long-term horizon ruler, right, 15 years, 20 years, investing in the stock market has traditionally and historically given you very, very strong returns. So over here, remember this quote over here, right? Market always reward disciplined investors. So if you're young like me, then you need to cast your view wider. And if you're old like me, then choosing good companies, buying to them, selling good options on them right now could be a potential strategy to consider. Now, a few more things I want to share with you is that I also look at the momentum of the market. Right now, this is the S&P 500 stocks that are above the 50-day moving average. And you can see very few times in the history in the last 5-6 years do we come to this current level where the number of stocks that is above its 50 moving average is super low, and we are here once again. So this is also another good news that potentially the market could be bottoming, right? Because the previous one over here, you can see we had a bottom, previous one over here, we had a bottom, and previous one, we had a small bottom before it continued to go down, and right now this could be the next bottom. And in fact, if you pull this out further into the 200-day moving average, right, we are getting an even stricter signal, right? So this is during COVID, right? We saw a bottom over here, and this was earlier part of this year, and right now we are touching the point once again. So really, I just want to leave you with this quote: "In the middle of chaos lies opportunity," by Bruce Lee. So really focus on what you can control right now as an investor, and whatever you cannot control, you just don't have to worry about them. So for example, you cannot control the Federal Reserve, but you can certainly control the quality of companies that you want to buy and the price that you want to pay. And right now, in the middle of chaos lies great opportunity. So I hope you guys enjoy this session and learn a lot from it. If you like the content over here, do like and subscribe. It will really help with the algorithm to spread this good investing news to many out there. Otherwise, I'll see you guys next time. Bye bye.